Yes guys, so let's start solving our workbook. That is your module 3. So workbook on IND AS 16 has certain questions that we'll have to solve. There's no solutions given out there. So we'll have to work around those solutions. So the solved illustrations are completed for us. So let's get into the workbook now. Question number 1. XYZ has acquired a heavy road transporter at a cost of 1 lakh with no breakdown of component parts. The estimated useful life is 10 years and at the end of 6th year, a powertrain that requires replacement for further maintenance is uneconomical due to off-road time required. The remainder of vehicle is perfectly roadworthy and is expected to last for the next 4 years. The cost of powertrain is 45,000 and the cost of new powertrain is recognized as necessary. If so, what is the treatment to be used? This is very similar to the illustration that we have come across under IND AS 16. So there is no significant difference here, but however, the discount rate is not given in the question. Since the discount rate is not given in the question, it will leave you with enough leverage to use whatever discount rate that you find is appropriate. So it is up to you. If you want to use 6% or 8% or 10%, whatever it is up to you. But I think we have used 5% earlier. So let us try to use 10% and solve this question. 45,000 is incurred for replacement of the powertrain at the end of the year 6. Therefore, we'll have to find out what is the original cost of the powertrain when at the beginning of year 0 when the original asset was actually acquired. Let's see how to solve this. If you know how to solve it, you can continue to solve, guys. You don't have to wait for me. Cost of replacement of the powertrain in year 6. What is the cost of the replacement? 45,000. So let us assuming a discount rate at 10% per annum. What should be the original cost of the powertrain? Original cost of replaced component calculate. What is the formula that will apply? 45,000 into present value factors for 10%, 6 years. Calculate 1 divided by 1.1, 3, 4, 5, 6. It is 0.5645 into 45,000. Answer will be rupee 25,403. But we will have to identify what is the depreciation up to year 6. Now the original useful life of the asset is 10 years. So this is depreciated over 10 years, assuming that there is no residual value. Useful life is 10 years. Since it is 10 years, we can find out what is the WDV on the date of replacement, the carrying value of the asset component, carrying value of component on date of replacement How do you calculate the carrying value of the component on the date of replacement? Use your formula. The original cost is 25,403 approximation, okay, minus 25,403 depreciated over 6 years when the total useful life is 10 years. 5,403 into 6 by 10. The depreciation is 15,241 or 242. The answer would be 10,161. Now, if I have to calculate what is the WDV of the asset after replacement, then we should go like this. First, start with original cost of asset. What is the cost of asset? Originally 1 lakh. Correct? What is the useful life? 10 years. If you know what is a useful life estimate, then you can identify what is the amount of depreciation per annum. Once you identify the depreciation per annum, you can identify what is the WDV on the date of replacement, or the carrying value of asset on date of replacement. Carrying value of asset on date of replacement, that is at the end of year 6. Correct? What is the useful life? 10 years. Then what is the depreciation per annum? Per annum depreciation is 10,000. Assuming that there is no residual value, because there is no residual value frankly given in the question. So 6 years depreciated 60,000. So what is the carrying value of the asset? 40,000. To this, less carrying value of replaced component charged to P&L of replaced component charge to P&L. How much did I charge to P&L? And then add cost of replacement capitalized to the cost of the asset. Cost of replacement capitalized to cost of asset. Try to identify both the figures. What is the amount which was charged to P&L? The amount should be charged to P&L is the carrying value of the earlier component, 10,161. Less rupee 10,161. Add rupee 45,000, which is the cost of replacement. Finally, the total value or the revised WDV or revised carrying value of the asset after the replacement is how much? Calculate. 40,000 minus 10,161 plus 45,000 which is nothing but 74,839. 74,839 is your answer. Now, this value or the revised carrying value has to be depreciated over the remaining useful life of the asset. What is the total useful life of the asset? 10 years. When did the replacement happen? At the end of the 6th year. What is the remaining useful life? 4 years. Remaining useful life asset. Depreciation per annum from year 7 to year 10. For the next 4 years is how much? Remaining useful life is 4 years. So the revised depreciation $18,710. 709 point something. So the revised depreciation is 18,710 is your final answer. That is the depreciation to be charged for the remaining useful life of the asset over 4 years. That is fundamentally the answer or the solution that I am looking at here. That has completed our solution to the first one. If you want to please take down the answer, please take it down. $40,000 minus 10,161 plus 45,000. Price carrying value depreciated over the remaining useful life of 4 years will give me 18,710, approximately the amount of depreciation to be charged per annum. Well, since we are done with that, let's look at the second question then. The second question, ABC is installing a new plant in its production facility and has incurred the following cost. Look at the cost. The cost of the plant is 25 lakhs, cost of invoice plus the amount of taxes included in it. Now, whether the taxes are refundable or not, he did not give me. So let us look at from there on. Initial delivery and handling charges of 2 lakhs supposed to be included to the cost of the asset. Cost of site preparation also to be included to the cost of the asset. Consultant used for advice on acquisition of the plant also to be included. Interest charged to the supplier for the plant for deferred credit. Guys, this interest will be only capitalized as per IND AS 23. Here he did not tell me whether it is a qualifying asset or not. So I will not be able to comment on whether these interest charges can be included or not. Here, estimated dismantling after 7 years is 3 lakhs. Operating losses before commercial production is 4 lakhs. Operating losses before commercial production is not eligible to be included. Clear? So let us try to solve this answer. This is our question number 2. First amount to be included in this is cost of purchase of plant 25 lakhs. It includes taxes. So please make sure that you write an assumption that these taxes are not refundable. If these taxes are refundable, then it is not eligible to be included into the cost of the asset. Purchase price, inclusive of taxes. What is the assumption that I'm making? Assuming that taxes are not refundable. It is compulsory to make such assumptions. If you're not making such assumptions, then your answer may not be relevant. The examiner should know that you have an idea that non-refundable taxes are only supposed to be included into the cost of the asset. Everything in rupee terms. Amount to be considered is 25 lakhs. Then part B. What is the second one to be included into the cost? Initial delivery and handling charges of 2 lakhs supposed to be included. Delivery and handling. Cost of 2 lakhs supposed to be included into the cost of the asset. No doubts about this. Third one. Cost of site preparation to be included 6 lakhs. Site preparation cost. Lakhs to be included into the cost of the asset. Part D. Next inclusion. Consultation for acquisition of the plant 7 lakhs. It is a technical advice 100% to be included into the cost of the asset. Technical consultation. Cost of 7 lakhs. Also supposed to be included into the cost of the asset. No doubt about this. What about the next one? Interest paid, which is included in the which is charged by the supplier for deferred credit 2 lakhs. I will only include it as per Ind AS 23. Since I have no idea whether this asset is a qualifying asset or not, let us assume that it is not a qualifying asset and these costs shall not be included into the cost of the asset. Interest on deferred credit. I'll apply Ind AS 23. Assuming the asset does not satisfy definition of qualifying asset. If doesn't mean the definition of qualifying asset. If it satisfies the definition of qualifying asset, then it is eligible to be included in the cost. As per Ind AS 23, you are not supposed to be included in the cost. Clear? But that is as per Ind AS 23 and not as per AS 16. Not Ind AS 16, it is Ind AS 23. Next cost to be included. Go back and check. Estimated dismantling cost of 3 lakhs supposed to be included. Estimated cost of dismantling 3 lakhs supposed to be included into the cost. Last one talks about operating losses. Last point talks about operating losses before commercial production. They cannot be included. They should be directly charged to P&L. They should be directly charged to P&L, should not be included in the cost. Operating losses before commercial production. I'm writing in brackets the treatment. They should be charged to P&L, not capitalized to the cost of asset. Amount is 0. Find out the total cost eligible to be capitalized. Total cost capitalized as per IND AS 16. Total it and check. I started with 25 lakhs, then 2 lakhs initial delivery, plus 6 lakhs of site preparation, plus 7 lakhs of technical consultation, plus 3 lakhs of dismantling. The total cost of the asset to be capitalized is 43 lakhs. That is it as far as your question number 2 is concerned. What is the amount of cost to be capitalized in accordance with IND AS 16? We have already identified the value. What about your question number 3 then? A Limited has an item of plant with an initial cost of 1 lakh. On the date of revaluation, the accumulated depreciation is 55,000. The fair value with reference to the transaction of similar asset is 65,000. What are your entries with regard to revaluation? Guys, we have already seen these entries. I'll just repeat them once again as a part of this question number 3. Question number 3. Original cost is 1 lakh. The accumulated depreciation is 55,000. Therefore, the carrying value will be 45,000 on the date of revaluation. Carrying value of asset on date of revaluation What is the revalued amount? Revalued amount. You compare with it, you should be able to identify what is your revaluation surplus. You should be able to identify the amount of your revaluation surplus. Calculate. If the carrying value is 45,000 on the date of revaluation and the revalued amount given to us in the question is 65,000, that means there is a revaluation surplus of 20,000. If I have to calculate this revaluation as a percentage, I'll tell you why I calculate, but I'm just calculating the revaluation as a percentage. as a percentage of carrying value. 20,000 divided by 45,000 as a percentage is 44.44. Now, this entry can be written in two ways. The same revaluation entry can be written in two ways. The first way of passing the entry is to cancel the amount of accumulated depreciation. So in such cases, I'll write the answer entry like this. First, cancel the amount of accumulated depreciation. Accumulated depreciation account debit. The amount of accumulated depreciation is 55,000, which has to be cancelled out to the cost of the asset, property, plant and equipment. Now, the asset which had a debit balance of 1 lakh, after charging off your accumulated depreciation by crediting the property, plant and equipment by 55, the value of PPE is today only 45. Now I will revalue the asset, PPE account debit to revaluation surplus. The amount being 20,000. This is one way of recording the entry. The other way of recording the entry is the second alternative. I'm writing it as part B, where I will still maintain your accumulated depreciation account. In such case, my entry is going to be written like this. PPE account debit. Increase it with the proportion of revaluation. 1 lakh is the cost of PPE. And you are increasing it by 44.44%. So that means this amount is going to be 44,444. To accumulated depreciation. Accumulated depreciation, which was 55,000. Again, proportionately increased by 44.44%. Is an amount of 24,444. Finally, that will result in a revaluation surplus, which is the balance figure from the entry of 20,000. Ultimately, there is no difference. Your transaction will result in the same amount of revaluation surplus. Both the options, the only difference is the way in which you record the entry. In the first one, I've cancelled the accumulated depreciation. Second one, I'm continuing the accumulated depreciation by increasing the asset value and the depreciation by the same percentage. Either ways you record, ultimately your answer will not change, will still remain the same. Clear? Moving to question number 4 then. B owns an asset with an original cost of 2 lakhs. On acquisition, the management determined that the useful life of the asset was 10 years. Residual value will be 20,000. The asset is now 8 years old, and during this time, there was no revision to the assessed residual value. At the end of year A, the management has reviewed the useful life and the residual life and has determined that the useful life can be extended to 12 years in the view of the maintenance program adopted by the company, as a result of which the residual value will reduce to 10,000. How will the above change in estimates be made by B Limited? Guys, if you look at, there are two changes which are occurring here. At the end of 8th year, there is a change in the estimated useful life. At the same time, there is also a change in the residual value. Both of them are change in determinants of depreciation. Since there is a change in determinant of depreciation, they should always be given a prospective effect. No retrospective effect. Here there shall only be a prospective effect. So let us look at the solution on how we solve this. My cost of the asset given in the question is how much? 2 lakhs, residual value 20,000, useful life 10 years. Two lakhs, estimated residual value, $20,000. Therefore, the depreciable value of asset depreciation shall only be charged to the extent of depreciable value. Amount shall only be 1,80,000. How many years? It has a useful life of 10 years. Once you write the useful life, you will also be able to identify what is the amount of depreciation which is required to be charged per annum. What is the useful life? 10 years. Therefore, what is the depreciation to be charged per annum? 18,000. Correct? Moving on from there, what else is given to us? He is saying, the other statement that he is making out there is that at the end of year 8, they have revised the useful life and the residual value, and it shall be considered as 12 years, and the residual value will only be considered as 10,000. So let's see. That means until 8th year, it is the same. There is no change until the 8th year. So therefore, carrying value of asset at the end of year 8, calculate. The total cost of the asset is 2 lakhs. How much am I depreciating every year? 18,000. Like that, for how long did you depreciate? For 8 years I depreciate. Calculate. 18,000 depreciated over 8 years. Total depreciation charge is 14,44,000. If I charge a depreciation of 14,44,000, then the remaining carrying value of the asset after depreciation will be 36,000. Now, what is the revised residual value? Revised residual value estimate is 10,000. Therefore, 46,000 should be considered as my depreciable value of asset. Depreciable value of asset is 46,000. What is the remaining useful life? At the end of 8th year, actually your useful life should have been 2 years, because the total useful life was 10 years. But now they have revised the useful life to 12 years. Since I'm at the end of 8th year, then I can expect the furthermore useful life remaining is 4 years. Therefore, the amount of depreciation to be charged is 11,500 per annum. This is the amount of depreciation per annum. Depreciation per annum. If you want me to make a statement, I'll make a statement saying that a change in determinant of depreciation is a change in accounting estimate. Is a change in accounting estimate, and therefore should be given a prospective effect. This should be dealt as per IND AS 8, guys. This change in accounting estimate we are talking about, this change in accounting estimate is as per IND AS 8. We will come back to that standard. We will understand both change in accounting policy, change in accounting estimates, and also another statement under IND AS 8 which is dealt with is called as errors. It is called as errors. Just give me a second, guys. I think the PDF is not proper right now. Yes, guys. So the question number 5 now. It was not clear, so I just changed it. So look at question number 5 now. X Limited has a machine which got damaged due to fire on 31st of January 2011. The carrying value of the machine was 1 lakh on that date. X Limited sold the damaged asset for scrap at 10,000 rupees. X Limited insured the same asset against damage, and as on 31st March, the compensation proceeds are still in progress, but the insurance company has confirmed the claim. The compensation is 50,000 receivable from the insurance company. How will the above transaction be accounted for? Guys, this has nothing to do with Ind AS 16. The pure basic accounting sense that you need. Now look at the question and tell me what do you find in that question. I find that basically an asset which had a carrying value of 1 lakh was damaged and it was sold as scrap for 10,000. Apart from this 10,000 which I received as scrap sale, I am also eligible to receive an extra amount of 50,000 rupees from the insurance company. How do you account for this transaction? Simple accounting is what is required. Question number 5. Bank account debit. Proceeds from scrap sale which I collected. $10,000. But remember, even an insurance claim is receivable. Claim receivable from insurance company is about 50,000. What is the carrying value of the asset which should be derecognized now? I need to derecognize the asset to property, plant and equipment, which is the carrying value on the date of derecognition, 1 lakh. The balance amount should be recognized as a loss on, whatever has happened. Is there a fire accident which happened? Why was the reason of damage to the machinery? Yeah, the damage was due to fire. So loss of fire or loss due to fire is the balance amount of 40,000. Loss due to fire. This loss due to fire should be charged to P&L. Should be charged to P&L directly. This is how I recognize the transaction in my books. So this bank account will be a current asset. The claim receivable from insurance company is also supposed to be presented as a current asset. Your loss due to fire should be charged off to P&L, and your property, plant and equipment should be reduced by its carrying value on the date of derecognition, which is 1 lakh. Let's look at the last question. Let's look at the last question, guys. That is question number 6. An entity has a nuclear power plant and related decommissioning liability. The nuclear plant started operating on 1st April 2017. The plant had a useful life of 40 years. Its initial cost was 1,20,000, which has a decommissioning cost of 10,000, which represented 70,400 in estimated cash flows payable in 40 years, discounted at a rate of 5%. So 70,400 is a decommissioning liability after 40 years, which when discounted at 5% to the present value is having a value of 10,000. Clear? The entity's financial statements end on 31st March. On March, the decommissioning liability is decreased by 8,000. Guys, the decommissioning liability is decreased by 8,000 and the discount rate is yet unchanged. How will this account for a change in the decommissioning liability? If it adopts the cost model, guys, you are adopting a cost model. The decommissioning liability of 10,000 included in the cost is reduced by 8,000. That means today the present value of the decommissioning cost is only 2,000. So how do we get this? Now, someone might come up and say, sir, I thought the 8,000 reduction is from 70,400 rupees and not from 10,000. I agree, guys, but very clearly he has said it is a value of decommissioning liability has decreased. Decommissioning cost is basically 70,400 expected to be incurred, but the decommissioning liability recognized is only reduced by 8,000. So let us start looking at this. Here guys, that's it, nothing. Year is given, only 1st April 2017 started operating and on 31st March at the year end. So that means it is only just at the end of first year. Question number 6. At the end of year 1, first, guys, at the end of year 1, first record the entry. First, you charge a depreciation. Depreciation account debit to property, plant and equipment. What is the useful life of the asset? What is the useful life of the asset and what is the original cost of the asset? The initial cost was 20,000, which included a decommissioning liability of 10,000 and had a useful life of 40 years. So 1,20,000 divided by 40 is what we are looking at. This is nothing but 3,000. Right? At the end of first year, there also has to be an interest cost on the decommissioning liability. Interest cost, account debit. It's a notional cost. It is not an actual cost. To provision for decommissioning or liability for decommissioning. It was 10,000. Add an interest catch-up of 5% every year. It was discounted at 5%. So interest catch-up is also 5%. So answer is 500. This decommissioning liability has been reduced. How much reduced? 8,000. So therefore, I'll have to record the entry like this. Liability for decommissioning or provision for decommissioning account debit. To the value of property, plant and equipment, because it was earlier included in the property, plant and equipment, and the amount of reduction is 8,000. So what is your revised PP? Revised cost of property, plant and equipment at the end of year 1. Calculate. 1,20,000 originally. On this, I charged a depreciation of 3,000. I am reducing the decommissioning liability by 8,000. Therefore, the value of the asset at the end of year 1 is 1,09,000. Same way, my decommissioning liability also at the end of year 1 has changed. Same way, my decommissioning liability has changed. At the end of year 1, originally it was 10,000. At the end of first year, it has an interest catch-up of 500. But it was reduced by 8,000 towards the end of the year. That means the balance amount is 2,000, 2,500. Now, guys, you might come up and say, sir, why shouldn't I consider that this amount is a change from 70,400 and not a change from the present value? Yes, we can definitely consider that, but the computation will be lengthy. The first question that we'll be seeing as a part of our addition to study material is one such example. So don't bother. I will definitely come up when there is a change in the estimate of the dismantling cost. How does the accounting treatment arise? How is the recomputation occurring? So these things I will come back. So please don't bother too much about that. We will come back and we'll look at that question.